Welcome to the Second Bite podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
And welcome to the Second Bite podcast. My name's Todd Taskey. Gregg Gallant is with me today, formerly from Allegient, has a great informative story to tell us about his entire process now. Selling the company and then recently getting his second bite. Gregg, it's great that you would spend some time with us today.
Yeah, thanks for having me, Todd.
I want to start quickly and just thank our sponsor, the people at TriVest. I don't know if you're familiar with them. TriVest is a really interesting private equity group. They're out of Miami. They've been doing transactions for 40 years, I believe. They've done over 300 transactions. They've got 3 different funds. They sponsor and focus primarily on founder and family-owned businesses. You can learn more about TriVest at trivest.com. You can also go to trivest.com/second bite, and they've got a bunch of resources there for people that want to learn more about them and get some resources from this topic as it relates to getting a second bite and private equity and the rest. So with that business out of the way, Gregg, thanks again for being here. I wanted to go back, if we can, to November of 2016. So, a handful of years ago. Can you tell us a little bit about Allegient, what the company did and the people that you served and roughly the size of the business at the time?
Yeah, gladly. Yeah, Allegient IT Services company that served predominantly Fortune 500, Fortune 1000 clients like Liberty Mutual, Eli Lilly. Very large clients tended to be our major focus as an organization. In 2016, we were doing about 35 million a year in revenue. A lot going on at that time. We were for the prior, I would say, 5 or 6 years, we had been growing about 20% a year growth annually. So we were moving at a fairly good size clip. Some drivers for me at that time, one was the growth rate. It takes a lot of cash to keep pushing back into the business in order to sustain that growth. And at about 35 million, when you're saying we got to put in, the 2 or 3 million that we're making that year, we got to put it back into the business. And when I was looking at, so, okay, how do I get from 35 to 50 million? My target at the time was really, because we had line of sight to getting to about $100 million in growth. And when I did that pro forma, I was like, it's going to take some cash to get us there, right? And my question for myself was, did we have the resources internally? So we began looking outside and saying, okay, how do we find an external partner that can help fund us and help us keep on that pace of growth? Well, at the same time, I had a minority business partner that had about 15% share in the company. He had turned 69 and he was raising his hand and said, "Hey, Gregg, I want to take some chips off the table." So not only am I going, how am I going to find a way to put more cash into the business? I had my partner, who was a great friend and a key to our success, was saying, "Hey, I want to take some chips off the table at the same time," which I couldn't blame him, right? And then I was doing some inward kind of thinking and looking at myself and going, I have a great team. That was a key part of our success, was the quality of the people we've been able to attract to the company. And it's a key for so many entrepreneurs as you look around and I got all these great people. And I was looking at myself saying, I'm the top of the pyramid. Are their careers growing faster than I'm able to get to provide them upward mobility in my own company? And that was a motivator for me. So with those kind of 3 drivers looking at me, I started a conversation, reached out to a couple brokers, and started having a number of conversations across the full spectrum, bringing in some capital to, ultimately to those that wanted to buy us outright. Some of them just wanted a partnership, and a variety of conversations ensued, and ultimately made a decision to sell the company in the low 20 millions as a transaction value.
And I want to come back to the economics on that in a second. When you started the process, because I have this conversation a lot where people start down one track, I want this, I want investment money, or I want to sell completely, or what have you. And it seems to ebb and flow based on the opportunities that come to you, the people that you meet, the economics of those different opportunities. How did it change as you were going through those conversations, or did you always stick true to what you thought you were going to eventually end up with as a transaction?
No, I mean, to your question, it went all over the place, right? We ended up, I think, in the end with five, maybe six different offers, and those offers covering a full spectrum of all equity deals to all cash deals, all, and I would say the offers ranged anywhere from the right around 20 million on up to about 28 million. Across again a spectrum of how they were leveraged and how they were formulated. Ultimately, we chose DMI as truly what I would say is a partner. Yeah, they bought us outright, but they were somebody that we had the best relationship with. We actually had a 3, 4 year conversation with them prior to them actually saying, "Hey, we hear you're having these conversations. We want to get in the game." And ultimately, we said, you know what? This is my baby. I want to hand it over to somebody that's going to take my baby to the next level. And we felt really good about that. And that's the one thing I think when I talk to entrepreneurs now, it's you got to find somebody that it's like sending your kid off to college. You want to make your kid make a really good decision about what school they're going to go to and take them to the next level. The same's true with your baby, with your company. And that's what I felt like I was doing. I took my baby to the right partner to see it go to the next level. And it did. It's something I'm very happy with the end result overall for making a good home decision on the home for my business. 4 years since we did the transaction, that business has more than doubled what it was when I had it by myself, and that makes me feel really good. Whole bunch of my team has been promoted and moved on to upper mobility opportunities within DMI. Been very successful for them, and I'm very proud of that as a result.
And I know that there was a couple of lessons learned in there, and I want to really dig into those because that's what the podcast is about, trying to pick up on those lessons. So let's just to simplify, because I can do round numbers in my head. Let's assume that the transaction was about 20 million bucks. Can you describe roughly how much was in cash at close? How much was in equity? Did you have any earnout? Do you remember those metrics?
Yeah, yeah. It was about I would say 65-35 cash and equity overall in the deal. So if on your $20 million number, I would say it's roughly 14 million in cash, 6 million in equity within the acquiring company. Going into it, we didn't have an earnout. That was one of the lessons learned. Is I think that's I don't want to say part of the game. It's what I say is part of the strategy of an acquirer. That they kind of know where you're going to be as a small company. They, get you so wed to the deal that all of a sudden they look at your numbers at the last minute and say, these numbers really aren't where we thought they were going to be at this point. We want to, put on a 12-month earnout as a result of that. And so 30 days before we were supposed to sign, suddenly they were talking about having a 12-month earnout when prior to that there was no earnout.
So let's go back to the deal for a second. You're at 14 and 6. They come to you and say, geez, Greg, your numbers are weakening a little bit. They took part of the 14 and 6 and said, listen, we want to get you there, but we're going to pay you a certain amount of the 14 and 6 a year later if you can do this.
Yeah, they basically said we want to take 25% of the value of the deal and defer it 12 months. And we want to see your performance over that next 12 months after we acquire you. We'll measure that. And if you hit those numbers, then we'll pay you the full value of that earnout. Right.
And
And
what
what they
happened with
did is
that earnout?
they looked at me and said, well, we're going to look at your pro forma that you put in front of us, and we're going to hold you to those pro forma numbers. What I didn't appreciate, not having sold a company before, is the distraction that selling your company does on the business, right? We went from literally I think 6 or maybe even 7 years prior, growing 17 to 22% a year, every single year. The year of our transaction, the year after our transaction, we grew 6%. It was my worst year out of the 20 years, except for I had one bad year prior to that. And this was the second worst year.
And can you point to something specific more instead of the big umbrella of it was the transaction? What underneath that umbrella could you point to as the real cause of the slowing of your growth in that time?
Yeah, it's there's a variety of things. It's the distraction for the leadership team. Suddenly you're looking at integration that I had a whole new set of bosses that I wasn't used to as an entrepreneur. It was a whole new set of accounting rules and accounting systems and marketing, new set of marketing folks and all the energy that we normally put into growing the business where I was out selling myself. Suddenly that time that I was out in front of clients, I was now with the marketing team. I was now working on accounting solutions, or I was at board meetings for the parent company and all this and that. And and that trickles all the way down. I can say the same things for my VP of sales. Suddenly he had an extra 15 hours a week of sales reports and everything else that he never had to do himself. And all those things trickle down and plus the energy of the integration itself, integrating our 250 people into a 2,000 person company. It's a pretty big effort to get that integrated. And so I failed to appreciate that was going to slow us down the way it did. And so end result for me was we didn't hit our numbers. Yeah, we got a portion of that earnout, but we got about 50% of what I was hoping for on the full earnout deal.
And is there something you would have done differently, or maybe more importantly, that you would suggest to people as you go through that due diligence? And because I know the knee jerk reaction might be get some help and outsource some stuff, but you don't want to tell anybody, right? It's a closely guarded secret that you keep just to yourself or the really inner circle. Is there something you would do differently now?
Yeah, I would recommend to any entrepreneur to bring in a very small group of confidential advisors. Right, you need your accountants. That's the number one thing I would say to any entrepreneur. Go have an early conversation with your outside CPAs and your wealth advisors to talk about your personal strategy. Right, it's one of the things I got some fairly good advice. About a year before we did the deal we set up a trust, an irrevocable trust that we put a portion of the company into that trust for my estate. And so that defers quite a bit of the taxes down the road. That was something I'm really happy with. What I didn't get good advice on that I'll tell any entrepreneur is that you're obligated to pay the taxes for that trust. So that was something that no one told me that out of my cash, I had to pay for all the taxes for the trust.
Your great great grandchildren will think of you fondly.
Yeah, they will. But it was when I was doing all my numbers and looking at what I needed, to fund my other activities. Didn't look at that obligation for the trust as part of my thing, and so that was part of it. The other things there with your tax advisors is talk about the basis that you have from a taxability standpoint when you do that transaction. That wasn't an open honest conversation that I didn't force my advisors to have with me, and so I got surprised a little bit there with the hey, there's a lot bigger portion of my income from the or my transaction value that was ordinary income. And so
Yes.
suddenly I, in my mind, went, oh, this is all going to get taxed at 20, 25%. And all of a sudden it's at, 43%. And I'm like, wow, that's a bigger, cash number. Again, when you do the deal, you're looking at what cash you're going to have at the end of that. That changes the number significantly. So that was one of the other things um, that I would throw out there.
And one thing, and I talk about this a lot, so I just want to highlight it to get your validation on it. I always tell clients when we put a deck together for them, nobody is going to pay you for next year's revenue. Nobody believes in next year's revenue, and it creates a hurdle that you can't overcome.
Right.
So, as an example, we have a client, we just signed an LOI last week. He did 33% growth in the most current year. He did like 29% growth the year before. His projection for 2022 is 20% because that's what we told him to do.
Right.
And I said to him, people are going to ask you, you did 29%, 33%. How come you're only going to do 20% next year? And I said, your response is going to be because I project 20% every year. That's just the way I do it.
Yeah.
Because so talk about your thoughts on that and the hurdle you had to get over.
Well, and it's the lessons learned of going through that, right? Because it- we're selling an asset, right? And so you get all caught up, and it's part of the deal and what it's going to be valued at and all that. What you're failing to appreciate when you have an earnout, or even when you have equity in the acquiring company, you need to put on the hat as an investor. If I was going to take, 7 or 8 million dollars, invest in this company, XYZ acquiring company, what are the questions I would ask them, right? Of what they're going to do with my money. And when you're selling your company, you get so caught up and you're in sales mode, you don't put your hat on as an investor. And that's probably one of the things I really wish I had done is when I said, hey, I'm going to give these guys, 6 to 8 million dollars of my money. What are they going to do with my money? Right? How are they going to ensure that my money is going to grow? What are the things that they're going to do to give back to really take the company they were acquiring and help it grow to the next level? I didn't do that. And so that's when I look back on myself and said, Greg, you handed somebody 6 to 8 million of your money. You should have been asking those hard questions of them about what
Yeah.
they were going to do to maximize the value of that 6 to 8 million.
And you're in the big leagues, right? I mean, because you're with very, very sophisticated investors that
Yeah.
back the company and owners of the company, guys that have taken companies public before, all that kind of stuff.
Yeah, and they've done this 15, 20 times before, just as individuals, never
Yeah.
mind with the private equity behind them.
And so you then in your equity, and this is always a question and so please elaborate as much as you are willing to and can. There's different classes of shares. There's preference, there's common, and then different classes of each of those things. What can you tell us about the cap structure you got into and the ultimate impact of that on the upside valuation you had?
Yeah, again,
Because
I
I'm
think
sorry, Greg, because the company you sold to recently just did a transaction and was sold to a very large private equity group. So you now, like with the rest of the shareholders, got full liquidity, so you can speak with certainty about the outcome.
correct, correct. But there's some. I'll be careful. There's some tailing non-disclosure things that I have
Tell us what you can,
to
please.
sensitive to in all this. But what I will say is that when I look back on the way the deal was structured, that they had a very large Wall Street investment firm come in and get preferred A shares in the company, and that they made a very large investment that my acquiring company then went and acquired my old company, Allegiant, plus about I would say 3 or 4 to maybe half a dozen other companies by this point.
And just to pause there, Greg, real quick, the thought process behind that is preferred A means we get our money back first,
Correct.
no matter whatever the sale price is, and we get a return on our capital.
Correct.
And the thought process there is, listen, we put in whatever the number is, 10 million or 100 million, and Greg took it out, right? They gave it to Greg. So we should be able to get our money back when we finally get to liquidity at some point in time.
Right.
So that's why you have the preferred A, but then they had other classes of stock.
Yeah, they offered us preferred B, right? And they said, you know what? You get, after those guys get their money, you're second in line and you get your money next, right? And then underneath that is common stock. So it was preferred A, preferred B, and then common stock. The other part of getting caught up in the sale, because they're big numbers here, and the big numbers get you really excited, and sometimes you don't think through everything fully, because when they were talking the big numbers, the plan was to take the company public, right? Their number one goal was to take the overall business public with the backing of a large Wall Street investor, right? The second goal was to sell to a public company and see all the shares, preferred A, preferred B, and the common stock transfer into a public entity. And so all of our scenarios that we had talked through were, hey, we're going to go public, or worst case scenario, we get sold to a public company, all of our shares get treated that way. Worst case scenario, they said, well, the worst case scenario is, we're going to make sure that you get your money back out of the company, but you're going to do it at a 5% a year compounded annual interest rate. And in fact, is whenever we do go public or sell, that's the value that the basis will be for that next transaction. What I failed to really, again, the lessons learned, I failed to have the conversation with my accountants that said, guys, walk me through the scenario is worst case scenario, they sell to another private entity or a private equity company. What do I get after X number of years? Pick a number, 3 years, 5 years, whatever it is, and have your accountants walk you through that scenario. I didn't do that. And so when this final transaction came around, I got surprised. I got surprised by the fact that the treatment of my preferred Bs was basically given multiple millions, we'll say, $5 to $8 million into the bank of that company at a 5% interest rate. And that was the basis for what I was going to get paid out. No appreciation over the value of the overall company because the way preferred B was and preferred A was handled, we didn't get common stock. So when they sold the common stock of the company, they looked at this and said, "Oh yeah, you got a 5% a year compounded dividend." That's
So
what
the preferred shares essentially were almost like debt.
it's exactly what it was. It was handled exactly like it was debt, but the negative side was being a owner in the company over the prior years. I got a tax basis adjustment based upon how well the company did, and so my basis actually got adjusted every year. What was different than debt is if I got paid out on debt, that would have been handled different from a tax standpoint if I had given it to them for 5 years versus the way this basis adjustment handled. So I can't complain. It's good. It's good money. I can complain to my counsel in that, guys, you should have made me aware of my investment where I was putting it at 5% a year for 5 years.
And so the investor, the A shares, were they treated just like the B shares preferred?
No, because they were smart, right? They've done this before. I hadn't, right? So they made sure that they were getting paid every year an additional portion of common stock. And so they every year they were getting a tranche of common stock that did go up in value as that rewarded them for longevity. So every year that they were in, they got an increasing amount of common stock, right? Thus incenting that company to do a transaction sooner rather than later.
Right.
They're
Right. Right.
smart. They were
Yeah.
smart on how they did it.
And so interesting. So you have an investor that will continue to get more the longer this takes. The
Yeah.
company, though, said, Gregg's a talent that we need and want to have here. So they did some things to make sure you would stay.
Yeah, they did, and like I said, I'm overall I'm happy with the transaction. It's just I have more heartburn in that I got surprised, right? And
Yeah, yeah.
like most entrepreneurs, we don't like surprises, especially if you knew Gregg Gallant. That was I always had a plaque on my desk behind me. It says "No surprises" because I don't like surprises.
Tell
Um,
me about what they did to keep you and
yeah,
keep you
and
excited.
so that's something I would encourage everybody. It's again, they knew my passion for the company, my passion for the space that we were operating in, and therefore offered me common stock. And so I did get common stock on a 3 year, or not, I shouldn't say a retention plan, I should say. It wasn't an
3-year
earnout.
vesting.
Yeah, I had a 1 year retention or 1 year earnout, but I had a 3 year retention package. Every year that I was there, I got a tranche of common stock that then would grow with the company.
Got it. And so from that standpoint, the you stayed all the way till the recent transaction where it was recently sold to another private equity group, or you transferred after your 3 years?
No, I stayed for about 6 months before. I guess it was 5 months before the transaction. The other part of my deal, and it's going to be like most entrepreneurs, really look at your non-compete. Was 52. I'm now 53, looking at a very strict 2-year non-compete. Not even anticipate didn't even anticipate that the deal was happening. In hindsight, probably should have seen that something was happening on the outside, but it was more me just saying I got to get the clock ticking on my non-compete. Because like so many entrepreneurs, I have the next idea, the third idea that's sitting there that I'm waiting to move on. And wanted to get that clock ticking. And so I left about 5, 6 months before to get the clock ticking on my non-compete.
And so let's talk about that for a second, because typically there's two places where you have non-compete. You have it in the transaction of the company, right? Where as a seller of this business, you won't compete against this business.
Right.
That's typically 4 to 5 years. And it
Correct.
starts at the day of the transaction and goes for 4 or 5 years.
Yep.
Then there's one tied to your employment agreement. And in your case, and 1 to 2 years is pretty common, that when you terminate, you have 2 years from that date. So for whatever reason, if you would have left the company at the end of 1 year, you would still have a 4 or 5 year non-compete tied to the sale of the company. And if you stayed for 6 years, you would still have 2 more years left based on your employment agreement.
Correct. And that's your explanation there is very similar to the arrangement that was in place. We had a 5-year overall non-compete and then a 2-year that's specific to me, regardless of when I left. So it's the shorter of the two. So the 5-year is basically out of place now, but I'm bound with the 2-year.
Got it. And so you are restricted. You did IT services, which is pretty broad category. Is it limited any?
No, mine's even broader. It's all IT related business. I
Okay.
can't. If I wanted to start my own software company right now, I can't. And I've had that conversation as well.
Got it. And so what are you doing then?
So one of the other things I learned, this is probably 10, 12 years ago. And some of my advice for entrepreneurs is find a group of peers that you can join and have good conversations with. I happen to find one of the groups that's a national organization called Vistage. And Vistage and I loved my group that I was in for I think 6 years. But it had a great group of entrepreneurs that had companies anywhere from I think the low side in our group was about 10 million on up to about 120 million. Very diverse from an economic or industry standpoint, but it got a lot of great advice. The other thing Vistage does is bring in speakers, and some of the speakers that they brought in were a set of economic or economists. Um, that gave great advice that heard. It took me 3 years in a row to hear the same speaker say it 3 times for me to listen. And it was about diversification. That as a business owner, you have all your eggs in one basket. You take money out, but then you generally put it into the bank or to the stock market and tend to be very conservative because you have all this risk in your business. The advice was to really think through the diversification strategy. You have a core business, whatever industry you're in. Look at how do you look at other diversifications. One was to get into commodities and move into commodity strategy. And then the third thing was to buy hard assets. So one of the things I got into was investing in oil. Never thought I'd be in the oil business. But as an entrepreneur, I started as an investor. The company I invested in went down an interesting path, and suddenly I started buying their assets and ended up buying the company 5 years after I started as an investor. And now I'm in the oil business. So I was IT services for 20 years, and for the last 7 years, I'm now in the oil business. And
Wow.
so I actually started the company prior to the transaction. And now I have two oil companies that we're running.
Is there a similarity between IT services and running an oil company?
No, there's very little similarity other than you're dealing with people. People, yeah, you need good people to run your business, people that you can trust, people that are motivated to grow your business, whether again, IT services or even in the oil. You need people that are motivated to grow and that you can put rewards in place to help them grow your asset. And so we've been doing that. The third strategy was buying hard assets, and so we've been also farmland and buying some farmland as well, which goes hand in hand with the oil business.
And the economist that came in and spoke at Vistage, can you reference them?
Yeah, it was the Bolio brothers. Brian, in particular, was a speaker that we saw multiple
Can you
times.
spell the last name?
It's Beaulieu.
Wow, I'm glad I asked.
Yeah, it's easier if you look under ITR economics, IT and then R economics. You'll see that's their
That,
company.
that's great.
Highly recommend those gentlemen and the work that they're doing.
And let me end with this, Gregg. In addition to my thank you for your time, you've been super successful as a businessman, I know, as a family man in your community and the rest. Is there anything you would ascribe credit to, whether that be an experience or a book or a mentor that you could recognize that's had a lasting impact on your overall success?
The timing of your question is interesting because my father recently passed away. But my father was an entrepreneur. He was a lifelong entrepreneurial across several industries, and I think that the lessons learned from my father, the work ethic, the passion, the willingness to take certain risks. And my father, like I am, didn't like surprises. So as an entrepreneur, you got to take certain risks, but you have to do the planning. You have to make sure that there aren't surprises in those risks, even though you're taking them. And that was a big lesson that my father taught me. The other part was giving back. Again, a lesson learned from my dad was giving back to the community, giving back to your employees. That's consistently one of the things I recommend to anybody that's looking to sell your company. Make sure you find ways to reward your employees through that transaction. It's something that we did in our transaction, it's something keeps employees vested, but it was just something. You get people working their butts off for you. You got to make sure you take care of them as well.
Hey, Gregg, thank you so much again for your time today. Super generous for you to share and to the level of detail that you did. So thanks a bunch for that. Thanks also to our friends at TriVest for their continued support. You can check them out at trivest.com. Gregg, best of success with your oil and land companies moving forward. And thanks again for your time.
Thanks, Todd.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.